we can cue our fancy intro music that we don't have. But Josh and I here today, we're going to go over what we are seeing in the residential space. It has been, well, it's kind of been a little quiet from our side, but it feels like it's been a crazy past couple months here of what's going on in the market as a whole.
Yeah, it seems like almost on a daily basis, if you pull up CNBC or whatever news source you look at, the market's up 2-3% one day and down 2-3% the next day, and the biggest trend you can get might be 2 or 3 days. That's as long as anyone on the street is going, and then it's flipping and making up the difference.
Yeah, it's been wild, kind of say. That's probably why we haven't, especially on the residential side, we haven't actively done a residential deal since the end of 2018. We closed those in 2019, but man, it's been quite a few years now that we have not brought out a new residential deal. We didn't bring anything out in the third quarter, so we're kind of recapping how the third quarter went, and it's another quarter with no real deals that we thought would fit on the residential side.
Yeah, and even those deals that we did, we basically executed the full renovation plan, leased them up, let the P&Ls marinate, and we've actually sold a handful of them as well between Oak Hollow and Heritage.
Those are heavy lift renovation. We're kind of that end of the 2018-19 phase was. Now we're talking about like very, very much value add. If there was stuff left in 2019, or even if there's stuff left now that hasn't had a renovation done to it, it's a little dicey on kind of the condition that's going to be in, right, to say the least, maybe. But so most of what we're seeing right now is we're just seeing a lot of volatility, a lot of ups and downs of what's happening, and that's hit us everywhere from the bank component. So bank bridge loan, that's something where you're normally going in and you're looking at a property and saying, hey, based on our track record, we can turn this around. We could do this deal, and banks would lend on that, kind of lending on the track record and the expectation of what you could bring to market. And that's pretty much all dried up.
Yeah, a combination of the small community bank lenders that we built our business with have all been gobbled up, and with a bunch of bank aggregation over the last couple of years, along with the banks wanting to take that risk of taking a property, maybe it's occupied but the rents are low, and you need to vacate that property and bring it all the way back up. That book of business for them is not of appetite right now for a bank.
Yeah. So essentially that means the lending for that is not there.
Gone,
not there. That's our experience. That's what we're seeing. It might be different in other places, but here in Atlanta, that's kind of what we've been seeing. And it's gotten tighter and tighter on that front over the past couple of years of what those loans look like. And now they're kind of gone for all intents and purposes. Another part we're starting to see too, and we haven't seen this on residential because we haven't done a new residential deal, but it has impacted refinance stuff that we've looked at, where we have banks that are basically having a signed commitment letter. We're going through the process with them, and then they're backing out of that commitment in the middle of a project, essentially.
Right, with the kind of historic rate hikes that have happened over the last 6 months, banks are being challenged on how they price deals, and are they pricing ahead of the market? Are they pricing behind the market? Can they keep up with the market? It's been really interesting. If you look at a chart of the U.S. Treasury, the 10-year Treasury, that's a lot of what our banks are tying their rates to, and it's had a ton of movement up and down. Trajectory has been up, but it'll have softening. Like this week is softer than last week.
Yeah. But that's also, we think about how the community banking world works. It's not like a mortgage where it kind of goes off to Fannie and no one assumes any risk. You're kind of like, okay, whatever. Most community banks are holding this paper, or they're doing an interest rate swap with that paper. So, or that by paper, I mean by that debt. So they're on the hook for whether they're making their depositors money or not. So they're very, very tied to how that thing is going to perform and what interest rates are going to do. Therefore, it makes them a little more hesitant. In our experience, that's what we're seeing right now.
Yep.
So, and also just, I don't know if it was like the crypto implosion or whatever happened in that.
Crypto winter.
The crypto winter, maybe. It's another thing that's added some volatility into the market as a whole. That's not a huge portion of the market, but it definitely, for the amount of news that it garners, makes it seem like a bigger part of what's happened in the world.
And collectively, this is all driving overall sentiment, whether it's with our banks and how their board of directors and their governing bodies feel, or whether it's with investors and wanting to get involved in really the next deal and the next market opportunity.
Yeah. So from a syndicator side, or a general partner who's putting together a deal, they're always trying to put together an opportunity that provides good investment returns to the investors, but then also makes sense for a bank to lend on. So if the banks are a little wishy-washy on what they want to do, especially if they've kind of gone down the road on deals and then back out of it, that makes it challenging. And then you have kind of the consumer side that's seeing a good amount of volatility. And then, we were talking about the consumer price index, or not the consumer price index, the consumer confidence level, where it's dropped a little bit this quarter, kind of back to where it was probably during the middle of COVID. So although lower, it's nowhere near where it was, go back to 2009 or anything from 2009 to 2014. So it's much better from then, but it still had a little drop here. So you got a little bit of decreasing in that, and you got some volatility and some unknowns on the banking side, and it makes deals a lot more challenging to pull off.
Yes.
So that kind of leads to, on the residential side, there are a lot of deals that were done not by us, but in the market by like the 3 cap kind of acquisitions where you're buying, you absolutely need rental rates to move upwards for you to realize you're one, just to get to cash flow positive, 2, to realize your value.
Right. And a part of the story of putting those together was getting a bank loan from a bridge bank loan from a lender that will give you a long-term interest only, tied to some treasury that was for the last 10 years has been historically low. Now that's not the case anymore. So the combination of all those things is making those deals harder to get done. And
it makes it all harder to do.
And driving up cap rates.
So I think from what we've seen in the residential space lately, we're seeing the very high end of residential slow down. Definitely slow down, and it's harder to do. One, it's harder to do deals with less bank debt, uncertainty with investors, as we've talked about here. So that brings a 3 cap going to anything higher than a 3 cap is going to bring down prices on that segment of the market. Where we can, where we have our deals in more of the affordable space, we didn't see anything that ever really got to a 3 cap. That's kind of outside of the realm of what we were operating in, but that's where the market's at right now on that very high end stuff. So, but if we look about the operator component, so not only are we syndicating deals, we're also operating the deals. So we have good insight into kind of how we're performing on the operating side. And our goals right now we've always been retention driven, but now we've had 3 quarters in a row where retention is over 70%. That drives our whole business. Retention, if it's too low or too high, if retention's too low, that means we have a lot of turnover. It means we're probably not doing a good job providing services to our residents. And then it makes it very stressful for the operating team that's got to go turn all those units and managers to lease everything. Like that makes the business harder and costly.
And retention, we can very clearly see it on both the income and expense side. If you're looking at an income statement, that our income's lower because we have the downtime of the unit being turned over and the lease-up time of finding the next resident. And the expenses are higher because we have to spend money on renovating that unit and prepping it for the next resident to come in. So that's our primary driver to focus on retention.
So you have less cash flow and more expenses. Yes. That's kind of the opposite of the opposite of the game, right? The game is to have higher cash and less expenses. But the other part though too is if retention is too high, then you're probably leaving some money on the table, or you're not able to get new leases that are in there. So we've always targeted 70%. We've had 3 quarters in a row now where we are right at between 70 and 75% retention. So exactly where we want to be. Kind of a push towards maintaining stability in the assets that we're currently operating.
And generally speaking, with retention in the 70% range, we'll do steady increases on the residents that are staying there. So say in the 3 to 5, maybe as high as 8% on resident renewals. And then when residents turn over, that 30% roughly that we see turnover on, we'll get much higher market rate increases on those that are closer to that 15 to 20% range. And overall, the blend is that year over year, we saw a 10% increase on income.
Yeah, across the board, all of our assets. we saw that revenue gain. So there's rental rate gain, but then there's revenue gain. So rental rate gain is what we're talking about when we're saying, hey, we're going to take a current rent to the market rent. That's the rental rate gain. The actual revenue gain is you look at all of the rents that are being paid, some that have renewed and they have lower increases versus the market increases that then come with expenses to turn that unit. So overall revenue of 10%, but yes, some market rate increases right now in the areas we're in have been significant over the past really 12 months. Right. It wasn't that crazy 12 months ago, but the past 12 months has really been where we've seen the bulk of the rental rate gains in the marketplace.
Right. And hence that's why we're seeing such high retention and such high occupancy. Our occupancy rate is in the 98, 99 range.
Occupancy, 98, 99%. We're only targeting 95% as, that's what we looked at when we're going into deals is 95%. Yeah, sitting at 98, 99% consistently for the past really 4 quarters. And then the past 3, we've had our retention goal hit exactly at what we're looking for every time. So, one part we are seeing, though, is the inflation component. Our operating costs on the controllable side, when we talk about controllable, we're looking at things like maintenance or how we're handling turnover, or a lot of the times utilities we see as controllable factors, ensuring that we have low flow water devices in place. We feel like we can control those items. Parts that are non-controllable is really taxes and insurance. Those, we do appeal taxes on an annual basis to make sure we have the right valuations at the different municipalities and see what that looks like. But overall, our taxes and insurance are up about 30% over the past 12 months. So, and we have our new tax bills. We still have some stuff being finalized for November, so the middle of the 4th quarter. We'll have some final tax numbers, and we also get our insurance renewal in the middle of the 4th quarter. So some room for those to increase a little bit more as we get through the end of the year. But right now we're looking at about a 30% increase across the board.
Right now, our operating teams know that these are the non-controllables, but we need to improve our margin and maintain our margin as much as possible. So we give them a lot of credit that they've actually held controllable expenses flat year over year by doing more work in-house, by monitoring vacant units and making sure we're not spending extra money to heat and cool these units, and overall, becoming more efficient as workers with maintaining our wages and salaries as we continue to grow the business.
Yeah, a lot of that too is doing stuff in-house versus, in the past, we were probably more like stick with a specific vendor relationship and we kind of keep that relationship going. It's consistent. Now with such drastic changing in pricing, we're looking at making sure we're getting more multiple bid scenarios on repair projects and seeing what we can do in-house with our team and our maintenance leads that are out going to multiple properties to kind of try and solve situations that they can. So let's talk about kind of our goals, right? So we kind of see the market being a little volatile right now from banking side, the investment side, the finding opportunities side. But the portfolio that we're operating, we're really just focused on stability. It's kind of been like that for a while, though. Our mindset of buy an asset, stabilize it, put long-term debt, and realize cash flow. We still have not changed our business model. We have not changed our investment philosophy over the past couple of years. I would say that philosophy has held us back from buying stuff really in the past 2-3 years. Sticking to that philosophy has made purchasing, we've purchased 0. So I wouldn't say impossible, but challenging.
Right, and our debt tells a really good story, our philosophy on business, right? All of our debt is fixed. The next upcoming debt is what, 2027, we said?
2025.
2025.
So we have one deal coming up in 2025.
And the next one after that is 2027. So we have some years to ride out this kind of interest rate storm that we're in the middle of right now, just kind of let things stabilize and see where things are going to settle out. In addition, our average leverage is in the 40s?
Yeah, in the 40% loan to value range. So typically most groups are normally higher than that. So we feel pretty good about that position. The loan we have coming up in 2025 too is like 30%, maybe even lower on the debt ratio. But we got that loan gosh, we probably got that loan in 2015 then.
Yeah, I think we're on a second or
10-year
third
loan.
5-year cycle on that loan.
Yeah.
Yeah.
So that one's coming up in 2025, which is still, it's like forever away in the kind of current environment that we're in, thinking out that far on an interest rate. And that one is, that one's at 3.99%. Right. So it's a good loan. We've got a few more years left on it. Yeah. And then after that, we've got a lot of loans that we're looking at 2029 or 2031. We have kind of these way out there loan dates where most of our debt is tied in that 3.7 to 4.7 range, and all fixed rate.
Right.
So we don't have any floating rate risk. So some questions come in around, what way are we going to limit risk because of all the rate changes? We don't really have anything else we can change on ours. Ours are all fixed. We kind of feel like we did our interest rate risk mitigation years ago in securing the fixed rate debt when we did. So everything is really long term right now. And our goal is to focus on the cash flow that we are generating, making sure we have strong balance sheets, making sure we're continually adding to the quality of our units. When we do have turnovers, we need to be able to spend the money to get them in the right condition to continue to have them perform in the market.
Yeah, so we're jumping right back to our income statement. Year over year, we saw a 10% increase on income and a 30% increase on controllable expenses. Let's talk about kind of what that means. So for every $100 of revenue that we gained, and this is just year over year, $100. So on top of previous gains that we've had. So we gained $100 year over year. How much of that went to controllable?
So $40 of that basically went to the non-controllable taxes and insurance increase. So while it did increase current cash flow, we're also looking at if we're just going to see continual 30% increases in taxes and insurance rates, it's like that's going to catch up with us. That's going to catch up with a lot of people in the long term. And when we think about insurance rates, we're always trying to do the best we can, quite frankly. But insurance rates on the liability side have almost, they've gone up 2x, really 3x in the past 3 years. So liability cost has gone way up, and then the property cost really hasn't gone up on a dollar amount that's being insured, but the values now are higher. So not only is property insurance going up, but the liability insurance is way up as well. And that's really helped push these non-controllable rates that much higher in the business. So while we are adding to cash flow, because for $100 rental rate increase, 60 of it was additional cash flow, 40 of it, $40, 40% went to the non-controllable expenses. That added cash flow though too, we are taking a good chunk of that, putting it in reserves and preparing for what's going to happen in 2023. Are taxes and insurance going to be higher in 2023 or lower? And I think for the most part, we assume they're going to be higher.
Right. Well, we'll assume that until they're not.
Yeah, until we see a year where we have a decrease in taxes and insurance rates, that has...
It's been a little bit.
Yeah, it's been a while. It's been a minute, right? So yeah, that's been a bit that has happened. So.
And then two of the properties that we're heavily reinvesting into the units, and there's not that many that come up on a regular basis, Amberwood and Kingstown. Both of these were basically taking, call it classic units is what we call them, and making them significantly nicer.
These are some of these units, we've had for a while, and we're almost on our second round of renovations in them now. And that's everything from we're putting in new windows, fully redoing kitchens, fully redoing not just hardware, but like doors. Everything's coming out as we put in new one. We're redoing the drywall on the ceiling. So after you have a few good years on some of these apartments, they require some effort to keep them in good shape.
Right. And on top of that, we're taking units that we're renting for $800 to $900, and after this renovation, we're getting closer to $1,200, $1,300 for these units. Yeah,
we're definitely seeing significant rental rate jumps on those, and what we're really doing is taking a unit that was good with lower rents and making it much nicer so we can realize basically current market rents in that area. So, yeah. And a lot of those areas too, where we're seeing single family homes. When we bought these deals, a single family home, could buy one for 50 grand probably.
Right.
And now some of them are 500 grand.
Right.
So the cost of living there, even if it goes from like 800 to 1200, is not 50 grand to 500 grand. That's a huge difference on that cost structure.
You remember our days at Amberwood where we, the guys next to us would hang outside with the 50-gallon drum.
Oh, they're just
burning everything out in front in the front yard. That's how to stay warm in the winter.
Yeah. Those were good days of putting that stuff together. But well, yeah, so our goal right now is really focusing on stability and cash flow. We have fixed debt long term. Our assets are all in good position with their reserves, and they're all generating positive cash flow right now. So we're really looking at just holding the assets that we have and operating them for cash flow, and kind of like a breath of fresh air compared to a lot of the other volatility that's out there. Our apartments have been pretty stable operating going forwards. We'd be super excited if we can get another quarter, if the fourth quarter could hit 70% retention too. That's a goal you and I have, maybe since the very beginning, we've always talked about retention.
First goal we ever set.
First goal we've ever made with that. If we could get a whole year where we actually hit 70% retention, it'd be pretty impressive. We'd be ecstatic if we can pull that off. So, cool. All right. Well, thanks for watching. That's everything for our residential update for the third quarter. We have some other updates that we're going to do on different asset classes like medical or industrial. And we'll have Andrew here for our retail one. So check out some of those other videos, and thanks for watching.
Thank you.